Hey guys, it's that Dividend guy coming at you with another Robinhood portfolio update. Happy Tuesday. Hopefully everybody's having a GGD, a great green day in the market. You know I always wish the best for my viewers and subscribers. So for today, we're going to go over the overall portfolio value, as well as the metrics of the portfolio, how our overall returns are going, the buying power sitting at 190.09, as well as we're going to take a look at the individual stocks and how they are performing. We're going to take a look at the dividends that are coming in for this month. And we're going to take a look at my watch list and talk about what price I'd buy Berkshire at. So jumping right in for today, we are down around $390, about a 0.5% loss for today. That 1 week mark, we are sitting in the green, about $190, a 0.32% gain. That 1 month mark, we are down around $680, down about 1% for the past month. Then we are up $6,100. We have about a 11.5% return here on that 3 month mark. Then year to date, we are up $9,600 with a 19% gain. That 1 year mark, we're up $13,400 with a 29% return. And then all time, we are up $24,161 with a 68% return. Right now, the portfolio is sitting at $59,000, right around $59,500. Of course, it's going to fluctuate because the market is still open. But we have a buying power of $190.09. That is from dividends and some leftover cash that I had left over from the buys that I did last month, which were Realty Income and T. Rowe Price. Then jumping into the individual holdings, starting off with the monthly dividend paying company, ticker symbol O, Realty Income, sitting at $63.26. We have 171 shares, $10,800 worth of market value. Average cost is right around $65 per share. 18% of the portfolio is in Realty Income. Today we're up $14. Total we're down $300, a loss of about 2.5%. So here would be a great opportunity to purchase more of Realty Income. Guys, this isn't the highest growing dividend payer in the portfolio, but I will say this is my favorite real estate stock. It pays me monthly like it would if I owned an actual real estate property, like a residential property. So that's one of the reasons that I really do cling to this stock. I love that it's such a big position and I do want to keep growing it, and it does kind of even out that monthly payment. Every single month that it pays, it does boost up my dividend income. It is known for not very big dividend growth numbers, but it is consistent. The one thing that I will say about Realty Income that I do like above other REITs is that I feel like it's a bit more insulated when it comes to economic downturns. They are very diversified when it comes to their client list. They're very good at selecting their clients, and they have never had below, I think it's a 92% occupancy. Even with COVID and the shutdowns, the economic shutdowns a few years ago, they still held above a 90% retention rate when it comes to getting their rent paid. So they've never really had a huge downturn when it comes to like losses when it comes to rent. And that is something that I love about them, is their triple net lease business model. And I think it's a great, obviously a great proven business model. They have an economic moat. They have been buying a little bit, it's a little bit different when it comes to the properties that they've been recently buying. But overall, I do like their tenant structure. I do like that they've acquired some of those smaller REITs and added to some of their big core fundamental tenants. So overall, even though the dividend growth isn't as high as, say, like a Visa, I still like it for the real estate play. I like it for the consistency, and this is one of my favorite stocks simply because of that consistent paying, and they are a dividend aristocrat as well. So a lot of reasons to like Realty Income. And I have gotten a lot of questions about why I still have 10K in the stock. Guys, the only reason that I would sell out of a company is if the fundamentals changed. So I don't think the fundamentals have gotten worse for this company. I think as they've acquired more of their main tenants from other REITs, I feel like they've gotten stronger. I feel like if I were in real estate and I ended up buying 2 or 3 more properties and my rent went up, I feel like that's a good thing. As long as they do a good job at maintaining their debt load and not getting too far behind, like too entrenched in debt, I think they'll be okay. And overall, I think that, over the past, they've been doing it for the past 2 decades, almost 3 decades now, for the dividend growth. They're very good at capital allocation, and they're also very good at knowing when and when not to get more debt, because that's essentially how they grow the business. Is they take on more debt, they buy more properties with that debt, and then they use that monthly cash flow to pay off those long-term contracts, or those long-term leases. And the triple net lease business model is phenomenal. That's one of the reasons why I looked into them and Triple N, and I do like Realty Income a little bit better because I like the tenant base. So overall, guys, I am not afraid to have a little bit more cash in this position. Again, it's not one of my core growth positions as of right now, because it's already such a big position. I do want Apple and Visa to be big, as well as Coca-Cola. Those are the big ones that I want to be putting more capital into. But given that Realty Income's at such a good price right now, I would add more to this position. Next up, we've got Altria, ticker symbol MO, sitting at $50.89. We've got 320 shares, $16K worth of market value. Average cost is right around $47 per share. 27% of the portfolio is in Altria. Today, we are down $70. Total, we're up 1,100 with a 7.5% gain here, which is surprising to see, because most of the time, Altria is one of those companies that is easy to hate. People love to hate it. Also, the other big thing is it's the single biggest dividend payer in the entire portfolio. Has a great yield, has pretty significant growth with the dividend, considering people think tobacco is going downhill over the long term. So the dividend's coming in on October 10th. So here in about a week and a half, we'll get $326 deposited into my brokerage account. Now, guys, the goal for Altria right now is to purchase more Apple. And as of right now, I have, as you guys saw earlier, about $190 in my account. So with that, plus the other dividends that I'm going to get, which we'll go over in a little bit, I'll be able to buy at least 2 shares of Apple every quarter around these prices. As long as it stays below, I think it was like $250 to $260 a share, I will forever be able to buy 2 shares of Apple, which is exactly what I want to be doing. So the reason I love Altria so much is because it could buy me a share of both Apple and of AbbVie if I wanted to. As of right now, I feel like AbbVie's a little bit overvalued, so I will be pouring money into Apple. So overall, guys, this does its job really well. I've also considered, if it stays at these levels, of course I'm not going to add to it, but if it drops below its average cost, I would not be opposed to putting the money back into Altria and gaining a significant amount of shares. I believe it's 10 almost, I think it's 13 shares, so it pays $1.02, so I'd be adding, like $10 to $12 per quarter by reinvesting those dividends. So the only reason that I'm not doing that right now is because Altria is above my average cost by quite a bit. It's about $3 per share, but that yield does go down as that price goes up. So as of right now, I don't want to add to this position, but if it were to drop to like that $46 range, I would reinvest that $326 back into Altria. But as of right now, I'm going to keep it pushing and keep pouring money into Apple. Then we got Coca-Cola. Again, this one is a little bit above my average cost as well. So, actually, it's way above my average cost. 15 shares of this Dividend King sitting at $71.70. $1,075 in market value. Average cost is $60.54. Right around 2% of the portfolio is in Coca-Cola. Today we're down $3. Total, we're up $167. We have an 18% gain here on Coca-Cola, and a dividend coming in of $7.28. So about $7.30 coming in here from Coca-Cola. So guys, this is one of those that I want to be a core position, but I don't want to overpay for Coca-Cola. And I think that $60 to $65 range is about as high as I'd want to go as of right now with Coca-Cola. So I won't be reinvesting dividends. I won't be adding to this position as of right now, but eventually quality will go on sale and I will put more money into Coca-Cola. Then we've got Apple at $225.88. Now, Apple's had a lot of bad news lately due to the DOJ lawsuit, but I'm actually happy about that. The more it goes down, the better for me. So sitting at $225.82 right now. We've got 6 shares, $1,300 of market value, which that had a 130 behind it instead of a 135. But I would love to have like $13,000 to $20,000 on Apple, and eventually I will. Average cost is sitting at $210.88. 2.3% of the portfolio is in Apple. I'd love to see that be 22%. Today we're down $42. Total, we're up around $90 with a 7% return. Guys, I want Apple to be the single biggest position in the portfolio. I slept on this company for a long time, and I plan on, jumping in and pouring as much cash, as much capital as I can into this position. So I love Apple for the long term. I was really dumb. I talked about the company a lot with friends and family, and I just never jumped into it. So this is my my redemption here. So by the end of October, I will have about 15 to 18. I think it's about 15, a little bit over $1,500 into the position. So slow and steady wins the race, guys. I'm not going to be able to pour money into this as much as I want to because I'm paying off credit card debt as is right now. But I do plan on making Apple the single biggest position and a very big dividend payer in the future. And I do think that this will help with capital appreciation and really good compounding within the company with a great competitive moat, great margins, and a phenomenal brand. So I just feel like Apple has one of the most impenetrable fortresses when it comes to reinvesting capital and those margins and that brand loyalty. And guys, the main reason that I'm investing in Apple is not for the iPhone sales. I could give a shit less about those. What I want is not them moving units. I want the overall spending on the Apple platform and ecosystem to go up, and that's what's been happening. Originally, when I was looking at Apple 5-6 years ago, my big thing was the Apple iPhone sales, and then they started to slow, and people thought Apple was going to lose its moat, and people weren't going to buy iPhones anymore, et cetera, et cetera. There was a lot of headline issues, right? But the one thing that I've looked into and that I really do think is they're going to be one of their big motivating growth drivers is going to be that ecosystem and how people spend. It's the marketplace that they spend their money on. That's what I really think is going to push Apple further into the future. It's that credit card space and those transaction fees. It is those small, like when people buy something on the iPhone store, on the Apple store, people underestimate how much revenue they get from their user base and how much revenue they get just because everything is so streamlined in that ecosystem. And so many people, I've worked in cell phone sales before, people would much rather stick to what they know and to what's comfortable than going into something new. So I think even if somebody innovates and maybe has a little bit better phone, maybe better battery life or screen or something, like, I feel like people are so attached to their devices now, especially with Apple and that brand and what that brand stands for. I don't think they're going to go and get a different product. I just feel like their lives are just so ingrained into that brand. I don't think that it's going to go anywhere. So, and I think that it will have a competitive advantage and really be a force to be reckoned with in the revenue. Even if iPhone sales don't continue to climb, I think that the overall profitability of the company is going to be based upon their store sales and some of the new innovations that they come out with. So even though I do know that Apple's very dependent on their iPhone sales, I think that's going to shift, and I think we've already seen that happen. Originally, when I looked at the company, it was the fourth biggest segment. Now it's the second biggest when it comes to their ecosystem sales. So I'm sorry, I'm not sure. I can't remember what that is called. Sorry, but that is the segment that I'm the most focused on. So overall, guys, Apple will be the single biggest position in the portfolio, and I'm going to slowly and steady, about trying to buy it around my average cost and try to be smart about when I purchase it, but eventually it will be the single biggest position. Then we got AbbVie at around $197, 95 shares, $18,600 worth of market value. Average cost is $95.19. 31% of the portfolio is in AbbVie. Today we are down $80. Total, we're up $9,600 with a 106% return here on AbbVie. Guys, I bought it during an acquisition. I thought people were really undervaluing what AbbVie brought to the table with Humira. They also got a bunch of other really big blockbuster drugs from that acquisition. And overall, I just think that they've had a really steady pipeline of drugs that has helped with that Humira fall off a little bit. So overall, I'm just going to keep letting this this garden grow. I'm just going to let the dividends come in and use it to buy more T. Rowe Price and eventually buy some Visa when it becomes applicable. So I'm not adding at these prices. Obviously, I've made 100% on my money. I'm not touching it at these levels, but I do see it as a very important pillar in the portfolio that will provide steady dividend growth and constant, continuous growing income in the near future. Then we got Visa at $278.50. I've only got one share. Of course, I will buy more soon. Average cost is around $270, so this is still a buy for me. I'm only up about 4%. 0.5% of the portfolio is in Visa. Today we're up around $3.60. Total we're up $10 with around a 4% return. So guys, this is going to be the second biggest position in the portfolio. It's going to go Apple, Visa, Coke. Then eventually I do plan on adding Google and Berkshire. Right now I want to be more focused on my pillars and put more money into those specifically before I add another company. So eventually, I mean, my goal with Google is to have it be one of the top 5 positions in the portfolio. It will take time. But the other thing is I have a deal with myself as an investor that I buy a share of Berkshire for every year I've invested. So as of right now, I own myself, I think 6 shares. It'll be 7 by the end of the year. So I'm a little bit behind on that. But Visa overall, guys, I love this business. I love the market that it just dominates. I love the profit margins and the honestly kind of the don't think about it, make money type business model. You know, there's so many businesses that I feel like get overlooked because it's weird because we use them every day, but it's something that's very under the radar. When you swipe, you don't think about it. You know, like when you purchase something, yeah, the money comes out, but you don't think about who transports that money to the bank and then checks it, and you know, all the intricacy, all the insight in and out of the money transmission process. Like there's a lot that goes on that we're used to it, right? It's like when you make a phone call, right? You don't think about all the science that goes into it. So it's just one of those that, like, it's one of the no-duh businesses. Everybody carries around a Visa or a MasterCard in their wallets, but nobody thinks about owning the profits from that business. It's the same idea as Coca-Cola. You crack them open all the time, right? You crack open a Coke or a Sprite on a hot day. You know, that's one of the reasons why I love dividend investing, is because I can own a portion of those companies, of those brands that I use every day. So Visa will be the second biggest position in the portfolio. It will take time to get there, and I might hold off a bit on buying a really big chunk because I want it to be below my average cost. So this is one of those that I'm going to sit and wait for a huge market correction and an overreaction, and then I'll jump in and get a bunch of shares. So eventually this will be probably about 20% of my portfolio. Then we got T. Rowe Price at $107.40. We've got 101 shares. I bought that one share with dividends last month. $10,800 worth of market value. Average cost is around $110 per share, so a nice buying opportunity here. 18% of the portfolio is in T. Rowe Price. Today we're down $150. Total we're down $230, down about 2%. Not a big loss here, but a great cost on average opportunity. I do love T. Rowe Price. I feel like it's one of those very overlooked businesses, and it is kind of cyclical considering the fact that interest rates are at 5% right now. I feel overall a lot of people got out of stocks simply because some of the stocks that they were in don't offer a guaranteed 5% return. Nothing's guaranteed in the stock market. Stocks fluctuate. At one point I was up like 10% on T. Rowe Price, and now I'm down 2%. So fluctuation is part of the game. But I totally understand why a lot of people got out of companies like, I remember Pepsi CEO saying, you know, we only offer 3% right now on our dividend. If they can get 5 guaranteed, I don't blame them for pulling out. You know, he's like, I think overall the stock will grow to a certain point, and I think it probably will, you know, eclipse 5%. But I don't blame people for getting out of certain companies and going into that 5% risk-free return. So overall, when people get out of the market, T. Rowe Price gets affected by that because they are one of the participants in the market, right? They own mutual funds that people invest in, but a lot of people, I'm sure, wanted that risk-free rate of return. So I'm sure they saw the overall assets under management dip a little bit because people pulled out of their stocks and put it into treasuries. So right now, I do see I do see a dip and I want to take advantage of it. But overall, guys, I think that the dividend's going to grow. They're really good at capital allocation. It's one of those very high margin businesses as well. And I just want to own it for the long term. So overall, guys, the goal of the portfolio is to use dividends to buy more shares of a company, either reinvest it back into itself or buy something else that I think is a better value or that has a higher growth rate long term. So as of right now, guys, I would love to just reinvest T. Rowe's dividend back into itself. And if it's still low enough when that dividend hits, I will reinvest it. But as of right now, I want to focus on my main three, which are Apple, Visa, and Coke. So when T. Rowe Price pays me, I'm going to buy Coca-Cola. So the way that my strategy has worked, and it's worked for a while now, is when Altria pays me, I buy Apple. When AbbVie pays me, I buy T. Rowe. And when T. Rowe pays me, I buy Altria. Now, I might switch that up and buy a Coca-Cola instead, just depending on where different prices are. But for me, it's a get paid and drip. Get paid and drip. So every month I buy the stock that's going to pay me next month. So last month when, last month T. Rowe paid me, and I bought a share of T. Rowe and I bought a share of Realty Income because they were both low at that point. So overall, guys, I'm just excited to see how high the portfolio goes. But also we have Berkshire on the watch list, guys. I love Berkshire Hathaway. I owe myself like 7 shares at this point. My girlfriend picks on me all the time because I don't own a share yet. So eventually I will probably over the course of like 6 months or something buy myself the shares I owe myself. So you'll see Berkshire added here relatively soon. I want to probably add it around the $400 mark. So I'll be patient and like I said with Apple, and just add it when it makes sense. So with that, guys, I just want to say thank you so much for watching. Remember to hit the subscribe button on my channel, That Dividend Guy. It really does help out. Hit the like button so more people see this video. I just enjoy sharing my dividend journey with you guys. Crazy to think that we started at 0 and we're already up to almost 60K. So thank you so much for watching, guys, and I'll see you tomorrow with another Robinhood portfolio update. Take care, guys.